Hello there everyone. Today's video we're going to take a look at how you convert non-qualifying loan interest into qualifying loan interest. So basically what do we mean by that is we mean that certain types of debt and the interest thereon are not tax deductible, but other types of debt are. So in this particular video I'm going to show you how you can convert the non-qualifying debt into some qualifying debt. But first of all, let's just consider the scenario of gifting shares. So let's say you've got an SME business, it's Mr. X who's founded the business, and he's been speaking to a tax advisor, someone like me, who says to him, look, why don't you gift some shares to your wife to take advantage of optimal remuneration strategy, and you and your wife can take out minimal salary and maximum dividend from the SME company, tax efficient from an income tax point of view. And when you gift those shares to your spouse, no capital gains tax because it's a transaction between a married couple, which this happens across thousands and thousands of SME businesses in the UK, I would suggest. However, what about, rather than gifting those shares, the spouse, Mrs. X, buys the shares from Mr. X rather than receiving them as a gift? Why would she do that? Well, let me explain. So, consider an example. In this example, Mr. and Mrs. X, and they have a joint mortgage on their house. So the house that they live in, and the mortgage is £200,000. Now, the mortgage is a capital and interest mortgage. So every month they're chipping away the principal as well as paying interest. Now then, the interest on that mortgage on their property is not tax deductible. Years ago in the UK, decades ago now, interest on mortgages, there was some tax relief. That has been long gone. So now mortgages on the buy-to-let property, mortgages on your residential property that you live in, no tax relief. So, what if the couple extend their mortgage for the purposes of being able to afford Mrs. X to buy the shares of Mr. X? So we do a company valuation and we say the relevant percentage that he's going to sell to her is worth, let's say it's worth £100,000. So the add-on 100 grand to their existing mortgage. So this 100 grand of cash, first of all, goes to her. She then gives it to him to buy the shares of him in the company. So she's acquired the shares. He's got 100 grand. He then uses that 100 grand to pay off the existing mortgage. To pay off half of the existing mortgage. So the existing mortgage was 200 grand. They borrowed another 100. It's ended up in his hands. He then uses that to pay off half of the original mortgage. So now they're left with two pots. 100 grand on the original mortgage and 100 grand on this new borrowing in order for her to buy the shares. So total indebtedness is still the same. It's still 200k, but rather than it all being linked to the for the purposes of having the residential property, half of that pot is now deemed to be a qualifying loan for tax purposes because the funds were used for Mrs. X to buy into an SME company, to acquire shares in a trading business. And that, in the tax law, turns it into a qualifying loan, and the interest thereon is tax deductible. So we've gone from a situation of having 200 grand of debt with interest, which is not tax deductible, to having 200 grand of debt with half of the interest thereon being tax deductible, because half of that loan is being used for the purposes of acquiring shares in an SME business. So a neat bit of tax planning there to basically get tax relief on half of that debt, on the interest thereon. A couple of things. To do this, you do need to get a valuation, and you value the business and whatever percentage you're looking to acquire. You need to obviously get the funding thereon. But essentially, here it is in a diagrammatic form. Original joint mortgage, 200 grand. Extra loan, 100, goes to Mrs. W. She gives it to Mr. W. Mr. W. He, or Mr. X, whatever I've labelled them, he then pays off half of the joint mortgage. So they're left with 100 there and 100 there. So it comes back to the same figure of 200 grand indebtedness. Only this time, 50% of the interest on the lot they get tax relief on, where before they didn't. And she ends up they end up with the same position that they would have done from an income tax point of view on the remuneration from the company. Remember, the dividends, the salaries, the whole point of giving her the shares in the first place, more for the dividend angle, that's still intact, as if he just simply gifted her the shares. But this gives you the added benefit of having that extra relief on the interest, which of course wouldn't have happened had he merely just gifted the shares. So on Mrs. X's tax return, she will have that deduction for qualifying interest. So something to think about there. If you are an SME business owner and you're thinking about giving some shares to the wife or to your husband, and you know it's tax efficient from an income tax point of view, but also make it even better, claim some interest tax relief by doing this and re-engineering the finances around your home to basically say, well, some of the pot now is used to acquire shares in a company, qualifies for interest tax relief. So just an overview there on qualifying interest. If you like this video, please do subscribe, and as always, I'll see you soon.